Dividend stocks have long been a popular investment strategy for those seeking a reliable stream of income from their investments. But there are several reasons why investors might want to think twice before buying dividend stocks. So, in this video, I will explore 10 reasons why you should not buy dividend stocks. I actually made a video about the best dividend stocks you can buy, so you can see it up there. Let's start first with what I think could be an issue to cover. The dividend stocks might not offer the best potential for long-term growth, so they typically distribute a portion of their earnings to shareholders in the form of dividends. Of course, this can be attractive to the investors that are seeking a regular income stream, but also limits the company's ability to invest in growth opportunities that could potentially lead to higher returns over time. There is a way to evaluate a dividend stock if that really offers the best potential for long-term growth. So one way to do that is to look at the company's price to earnings growth ratio, which is called PEG ratio. So this ratio compares the price of a stock to its expected earning growth rate. So a low PEG ratio might indicate that the company is undervalued relative to this growth potential. Next one is not sufficient diversification. So dividend paying stocks are often concentrated in certain sectors such as utilities, consumer staples, and they might not really perform well during times of economic uncertainty or market volatility. They usually stocks that are not anymore maybe in that very high growth potential, like startups. Another factor that we need to cover here is the tax efficiency of the investment strategy. So this dividend income is typically subject to the higher tax rate than capital gains. Of course, I'm assuming, of course, it depends on the country where you're living in and the tax rates there. But usually, capital gains have a lower taxes than income tax. So dividend stocks are subject to income tax. So that's why I don't believe that could be very tax efficient. Another one is dividend stocks might be overvalued. So overvalued relative to the earning potential of a growth prospect. So there could be maybe disappointing returns for investors over time. Let's make an example here. If the company is unable to sustain its dividend payments because of a lack of earnings growth, the stock price might fall, potentially resulting in losses for investors. So to evaluate the potential risk of investing in dividend stocks, the investor should carefully consider company's earnings growth potential and valuation. Let's see how we can do that. So one way is to look at the company's price to earnings, PE ratio, very famous. This ratio compares the price of a stock to its earning per share, EPS. A high PE ratio might indicate that the stock is overvalued relative to its earning potential. Now, you might be asking, where can I find all this information? Nowadays, it's very easy. There's a lot of websites that can tell you, Stock Screener, another video I made that could be used as Stock Screener to quickly see all these ratios. You can see the link to the video up there. Another point is companies might cut or limit their dividends, and this has happened recently to a few companies. Like the first that I'm actually thinking about is Intel. They just recently did that. Why that happens? Because if they cut the dividends, it immediately results in a significant loss of income for investors, and let's see why. So cash flow problems could arise when a company is unable to generate sufficient cash to pay the dividends. So there are several reasons why a company might experience cash flow problems. So there could be declining revenue, increasing expenses, high debt levels. So when a company experiences cash flow problems, it might be forced to cut or limit the dividends. So and this, of course, is a loss for the investor, and also because when the company does that, it does signal to the market that there are problems, and definitely it could be that quite a few people might start to sell the stock, especially those that are looking for a certain amount of dividend return. Now, what is the next one? The dividend stocks might also be vulnerable to interest rate changes. So this is a bit debatable, but when interest rates rise, the investor might shift their investment away from dividend-paying stocks and towards fixed income securities such as bonds. So this is because when the interest rate rise, like is happening now, especially in the US, the yield on the fixed income securities increases, so making them more attractive to investors seeking a reliable stream of income. So the demand for the dividend-paying stocks might decrease, which can put downward pressure on their prices. In some cases, some argue that a rising interest rate can be positive for dividend-paying stocks because it's a sign of strong economy, which can lead to increased earnings and cash flow for companies. So yeah, this is a bit debated, and not everybody agrees on that. Dividend stocks, next go to the next one, might not provide sufficient protection against inflation. So they might not be able to keep up with the rising cost of goods and services over time, and price increase, the purchasing power of a given amount of money decreases, of course. So even if a company maintains its dividend payments, the value of those payments might decrease over time. And we have seen that, of course, high inflation in the last few years in most of the world. And in certain countries, of course, inflation has been high for a long time. So how can we evaluate if a dividend stock is likely to provide protection against inflation? So one of the factors, the most important one, is the company's pricing power. You probably heard that pricing power a lot in if you follow the experts that talking about stocks. So companies that have a strong competitive position in the industry are therefore able to raise prices, and they could be better positioned to maintain the purchasing power of their dividends over time. So it's if it's a strong brand, if it's a product that people need regardless of the price, these companies can raise the prices, so they have pricing power. Now, another one is dividend stock might not be suitable for all investors. Why is that? Investors who are in the accumulation phase of their investment journey, they might not really need a regular income stream like retired people. So they might be better off investing in growth stocks that have the potential for higher long-term returns, and then over time maybe switch slowly to dividend stocks, because of course we have seen in the last few years growth stocks have definitely outperformed dividend stocks by a lot. Another one, dividend stocks might not be the most effective means of generating income in retirement. So this is a bit counterintuitive. Other income generating assets such as annuities or rental properties might offer a better long-term income stream. A drawback of relying on dividend stocks for retirement income is that the income stream might not be really stable or reliable. The dividend payments that we have seen before can fluctuate based on the company's financial performance, dividend policy, market condition. This means that the investors that are really entirely relying on that stream of income are I think not properly diversified, and they should definitely consider maybe a bit of real estate, a bit of other source of income, of course. Then another consideration is dividend stocks might not offer, as I said, sufficient diversification because there's no exposure to other asset classes such as bonds that can offer lower risk and more stable income streams. Last one, the dividend investing also requires a lot of research and analysis. So the investor needs to evaluate the company dividend payout history, the financial stability, growth potential, and a lot of people don't have the time or the willingness to do that. In conclusion, while dividend stocks may be an attractive investment option for some investors, there are several reasons why investors might want to think twice before buying them. They might not offer the best potential for long-term growth, not be sufficiently diversified, not be the most tax-efficient strategy, and might be vulnerable to interest rate changes and inflation. So that's, of course, like any other investing strategy, requires research and analysis. So I think it depends on personal preference as well. That some people are really into getting their kind of regular income stream like that, so they might be really more willing to invest in this kind of companies. Thanks for watching the video. If you like this video, please subscribe for more of this content. Bye for now.